minimum down.
Sorry.
That's okay.
And I did find your video.
Oh, good.
I sent it to the 3 of them, and
Okay.
and then we'll send it out to the rest of the new agents. Sorry, go ahead.
That's okay. So this tells you kind of the down payment requirements, just at a glance. What you could perhaps negotiate for seller assistance, although put a big asterisk next to that. Nobody gets it anymore right now because sellers are not really giving a whole lot of assistance because of the environment that we're in. Kind of, it's a quick at a glance to tell you what you got to have for credit scores. Sometimes customers will ask you, thinking you know everything, what do I need for a credit score? I just checked Credit Karma and this, that, or the other thing. So this is something that you can refer to very quickly. Please keep in mind that our world changes a lot, and sometimes often, especially right now, since the pandemic, investors are constantly evolving and changing the dynamics of what they require for things based on their comfort zone. What can they stomach to buy loans? So we often don't get a whole lot of warning that they change, but when they do make changes, it's usually across the board. Where one does it, they all tumble through and do it at the same time. So please know that this particular packet of information is not in stone. Sadly, it's always changing and evolving. So behind that conventional chart on that page, I gave you some worksheets. They're just, again, these are all at a glance, quick look at to get an idea for how we structure at Dundee. Every bank is different. We may see different fees for different companies. These are things that are indicative to each of us on our own. They are not the same for each of us, nor are the rates. Rates are driven by what investors charge and how we as a bank are willing to offer those to make sure we keep the lights on, pay the staff. You know how that works. Okay, everybody has to be able to make something to keep going. The next thing I've put in there is FHA. FHA, again, it's got a different set of criteria for your down payments, your credit scores, the tolerance of what they will allow for different things. I would say when you think of these programs, I like to use kind of the visual of, think of a sandbox. Conventional sandbox is small and rigid. It doesn't have a lot of room for movement. If you fit in the box, great. If you don't, it's very difficult to get in the box. So we have to look at programs that will allow it. Think of FHA as a much bigger sandbox and the sides bulge. We can kind of help folks that may not be able to fit in the little box get into this one and at least purchase a home. And that might be a stepping stone for them. We start out FHA, and a couple years down the road, when we get them stronger and secure everything that we need to do for them, we take them over and refi them into a conventional loan, which gives them a little better structure. But at least with FHA, we can sometimes help them get in to a home and get started on building equity. Behind that FHA chart, there's more cost sheets kind of tell you how those work. VA sandbox is invite only. Think of it that way. The only way to get in there is if you're active or you're retired, service member. And Nikki and myself do a very, very large portion of our business is VA. So we have a lot of experience with that. If you have any questions, because they do have some different variables and details that go with different aspects of those loans that are very specific to our military members based on their service and their eligibility. So let us find out how their situation warrants moving forward by checking out their certificate of eligibility and things like that. So we can do all that legwork for you. There's no way that you can do that because you have to have special clearance to get into the VA portal. and look up some of those things. But we can do that for you. Even if they don't use us, we can still help you get that information. So kind of keep that in mind. So VA's chart is in here. VA worksheets are in here that give you kind of a cost breakdown. I put a USDA in here. USDA is interesting because they are actually considered a conventional loan, even though they're government regulated. And they are loans that are available to folks buying in smaller communities. There's a restriction on the population size. So in order to know, for example, if you have a client that wants to look at an address and it is rural, to be sure that it could qualify for a USDA, there is a website that you go to, which I've given you farther along in the back, that you can click on, drop in that address, and it'll tell you immediately if it's okay to do a USDA there. It's very important to check that, because you cannot do a USDA if the population size of the city they want to buy in is too large. So for example, Weeping Water, Waterloo, Louisville, those smaller communities, Plattsmouth, those are all going to be okay for USDA, but Gretna has grown so much in the last few years that I think they are either border or out of being able to be used. I have to look up the address myself just to be sure whether Gretna is still in it or not. But Omaha, of course, would not be, Bellevue, none of those. So we want to make sure that USDA is the address is looked up just to be sure that it's okay to use that financing there. And those loans have some very specific requirements. I will tell you that one of the things we have to be very careful of is USDA will not lend on a property that has a lot of outhouses. And I'm talking chicken coops, small sheds that farmers have used. These rural areas sometimes have a lot of that. They have house barn or horse barns, and they have different kinds of things like that. Above ground pools, they are a big no-no for USDA. They won't give any lending on those. So we want to be careful. They may just need to do a regular loan like everybody else does if we've got a lot of those outbuildings out there. And just ask me how I know that. That's painful to learn.
Know that, Alan.
Lessons.
I thought you were talking about outhouses, like a whole lot of outhouses, like
No, like outbuildings like the chicken coops and stuff like that. Because a lot of those rural areas, we like to have gardens, and we like to have chickens, and we like to have livestock, and we like to have some of those things. And as owners of that property, there's a value to them. But when it comes to USDA, they're like, yeah, there's value, but that's not going to work for our lending. So we may just go traditional on something like that.
how many of those, can I ask you, how many USDs have you done this year in this market?
None, nothing in probably the last 2 years.
Really? Wow.
Mm-hmm.
Okay.
Yep.
Is that pretty much across your
The
industry?
things that we've had that have been rural, people have had funds to put down.
Yeah.
And just go with a traditional type financing. We haven't had folks that are trying to get that 100% financing type loan. So
Do you have numbers on that for the year for, like, excuse me, the amount of conventional versus FHA, VA?
I could get them for myself, but they're going to be skewed because I do so much VA. And
You do? Okay.
It's probably
that's a bigger percentage of what you do. So this is part of why I want you guys to meet Alan, first of all, to know that she's an amazing resource, but she is right there on the front line of all that is financing. And What she just said about she does more VA than anything else, that is a huge selling point for you when you're making a referral to your clients is, I'm referring you to this person because they do a load of VA. I know a lot of lenders that haven't done hardly any VAs this year. Not that they don't know how or have known how, but have not been able to help us to get those accepted. So
very difficult, very difficult.
Very, very difficult.
FHA is very hard too.
But it can be done. It can be
can.
done. And it's a combination of all these things that we're trying to teach you guys about, bringing all of your team and your resources together to make it happen. But I will tell you that the number one, I think, and I know this is true, the number one most important confirmation in any transaction this year is about money and financing. And the stronger that is, the better relationships that you have with your lender or lenders, the better chance that your clients have of getting accepted offers. So
it's very true. We have to make the approval letters spotless. They have to be encouraging. They have to be seller friendly. They have to be simple. So we do a lot of groundwork and we get a lot of things done before those letters are ever prepped, so that when they come across to a seller, they have virtually nothing on them. And that's the way a seller wants to see it. That's going to be, you compare 1 or 2 items to a letter that has 5 or 10 items. Well, you as a seller are going to look for the simplistic route, that makes you feel secure in what you're doing. So that's Carol's very right. We're up against cash, and cash is very difficult to overcome unless you are just pristine with what you're offering. So we have to make it shine, come out of the gate kind of guns a-blazing, if you will.
Which means you have to start early in the transaction to make sure your people are not only just pre-approved, or what's the other one, the other level?
Pre-qualified,
pre-approved. If you can get them all the way through to where they're ready to go into underwriting with the transaction that you've got, mitigating risk to the seller, number one. The seller wants any risk mitigated, and your lender has the ability to be able to help you to do that more than anybody.
One of the things that we're seeing is we're writing in contracts that our buyers are willing to cover differences in appraisals, differences in costs. That's all fine and good, but as a seller, my first question is going to be, has anybody verified they have the money? Do they really have the money? Because if they do, that makes me feel a lot more confident than I got to go get the money, or I'll figure it out.
We'll figure it out later.
Yeah. So sometimes we even put verbiage in that, we've confirmed cash, so that it takes that element away of uncertainty. So
the gap.
I was going to ask, sorry.
Confirming the gap cash.
Yep.
Do you include that? Is that all part of the pre-approval letter, or do you do a pre-approval and a proof of funds?
That's a great
with
question.
The offer?
That's a great question. We usually don't do proof of funds, but what we will do is we'll put in there verification of cash to close, and then we'll put something in very dark, bold, bright, fireworks type letters, whatever, that says cash has been verified through bank account, blah, blah, blah. We don't need to give any more information, I don't think, than that. No one's ever asked me for a bank statement. Now, I've seen that on cash sales, of course, where they want to know that there's proof of funds. But for my stuff, I just want to make it look good and take the fear away from the seller.
I like to highlight it. That's good. Yeah.
And just verify that's included with the offer, like simultaneously.
You almost always right now have to have a letter of approval with your offers. because there's so many. And when your listing agent gets them, they're sorting them. They're looking at them. This has got a letter, that one doesn't. You know, this one's cash, okay, it sits over here, and these are government ones, and those get pushed to the side. And, you know, so if we have a really pretty letter going with it, you know, sometimes we can get up into those couple, 3 that are going to be looked at in that final round.
Do you, do you call if the agent asks you to, do you call?
Absolutely. Yes,
It's
absolutely.
you guys too. So.
Yep. In fact, last week I had 2 of them. So it kind of goes in spurts. So there'll be a group that never asked me to call a listing agent. And then all of a sudden I have, like last week, we had 2. You know, and one of them was over the weekend on a Sunday, and that's okay. But you have to be careful, you know, because as you know, a buyer's agent, I might be trying to be proactive, you know, and say, hey, will you call my listing agent and tell them how great they are? But they didn't clear it with them, you know, and here I am calling on a Sunday and they're sitting in church. So I usually ask the question, are they expecting my call? Because if they are, then I know they're ready for me. But if they're not, then I'm going to say, hey, will you let them know I'm going to call? Because it isn't always the best tactic to use. And I want to make sure that they're wanting me to do it. You know what I mean? Does that make sense?
Yeah. Yeah.
So
Sarah,
just a little bit more in this packet. Just yes.
I do have a question. When you were talking about the USDA, so I'm from the Bennington area and there's some acreages out there. So in your experience, like a smaller acreage would maybe be more of a conventional loan.
Well, USDA is conventional.
Okay. Oh, that's right. Sorry.
Yep. Nope. That's okay. So
okay.
USDA is a conventional loan, and that is okay to do out there, and probably much more in tune with what you'd want to do. We would just need to make sure that when we do acreages, there is sometimes a disparity between the value of the home and the amount of the acreage. So we have to look and see, what is that acreage? Is it 5 acres, 10 acres, 20 acres? Because there's a value to that, right? So if for some reason that acreage, the land, would exceed the value of the house, for example, my husband would love to have a tiny little ranch and a big shed twice the size of our house on land that goes on till you can't see the end. Right. Well, those aren't going to work for a traditional loan, because when we make our loan, pretend you're the bank. All you're looking at really is the house. And that value needs to be supported by the home more than it needs to be the land and a barn and, you know, a shed and, you know, all that kind of stuff. So we just have to be careful. And before we would commit to doing a USDA, we want to look at the listing, maybe ask your lender, what do you think about this? Can you take an eyeball, you know, view of this and just kind of look and see what we've got going on, and we can help you do that.
Okay.
Any lender can help you do that does USDA, they know.
Okay.
Is that like the big hat, no cattle, or no cattle, big hat? Small
yeah.
hat, no hat, lots of cattle.
Yeah, exactly. And, you know, there's a lot of us that would just like to have a whole lot of land around us so there's no one there. No.
Yeah. And you know what? There's more and more people now that want that. I can't even tell you the number of people that we have had on our list of we're looking for a place since last year, particularly. Like, just get me away from everybody.
Yes, more now than ever, for sure.
I understand. So if you find that place, let us know.
Right? Exactly.
We know a good lender.
We're creative. We'll figure it out, right? So anybody else think of any questions for right now and that stuff? Oh, good. All right. So our little packet really, you know, it goes into more definitions of things just so that you have it. I went into payment options because people have started to ask about ARMs versus fixed rates. We're not doing ARMs right now. They're out there, but the pricing for a fixed rate is so good. Not going to see a lot of ARMs floating to the top until we get into the 6, 7, 8% fixed rates, because it doesn't make sense to do something that's risk-based and can change when and adjust when you could pay the same and have 30-year fixed for 30 years. So the investors aren't even, I mean, they don't even have ARMs priced properly. So, but once in a while you have somebody who's like, well, I'm going to only be here for 2 years because I'm just finishing up school, or I'm going to, like VA, we have adjustables for those. And they're saying, oh, well, I know I'm only going to be here 3 years, stationed here for 3 years. Well, I'll show you the prices. I'll let you make the choice. And they always go fixed because they're better. So I put them on here just so that you know. I put information on how they work, how do adjustable rates work. You could probably skip all of that for now because there's just nothing going on.
Are you also talking about like the 3, 5, 7 year?
All of them. Yeah, there's nothing.
It's interesting because and you guys, they probably see this too. So I want you to, I like that you're debunking it, is a lot of ads are out there for, okay, here's 2.3% for a 5-year ARM or a 3-year ARM or a 7-year ARM. So those are not being done.
They aren't, because they charge fees for them. Mm-hmm. So even though you can get this wonderful tickler entry rate, mm-hmm. you're going to pay points for it. And then at the end of whatever it's being touted for an adjustable time frame, let's say it's a 3-year, at the 36th month, it's going to change. And you paid for that lower fee, to begin with. You may find that it goes up its entire amount within that first 3 years. So you have to read the fine print very well on where the floor and the ceilings are on these things and how long they're amortized, because after, let's pretend for 1 second that we're doing a 3-year ARM. At the end of 36 months, we have the ability to go up or down. And the next 12 months, it does it again. And the next 12 months, it does it again. And so it's an ongoing, where's my rate going to be, where you could pay nothing for a rate and have it good for 30 years and never worry about it going up or down. Does that make sense?
Okay. So I want them to understand this so that they can have a basic understanding to be able to talk to their clients and then refer them to you.
Sure.
For the real information. But so even if somebody says, look, I'm only going to be here, we're only going to be here for 2 years, we really would rather just go with this other rate. It's all about the points that they have to pay to get that rate. That's
right.
Really
and sometimes there are points and sometimes there aren't. Yeah. And we give them all those options. If they push to want to know what an ARM is, well, we most certainly can look those up for them. And we can show them, here they are, and here's what happens on the ARMs and how they adjust and when they adjust. The problem is we don't know what the adjustment will be because it's 12 months in the future. It's 36 months in the future. It's whatever that future figure is. So there's no way for us to know what it's going to be, but we can give them an idea of where those things are. Plus, of course, tell them where it's at right now.
And it's also betting on the economy. It's also betting on a whole lot of unknowns, which is what took down the market, part of what took down the market in 2007, 8 with negative amortization loans. So you would get a loan that was at 1% and it was gonna redo at 2 years, which the market was doing great. So everybody was like, oh, hell yeah, let's do this. We can buy more than we can afford.
Yeah, and then they went up to 8% and no one could afford the payments anymore. Yeah.
but at the same time, the value of their houses went down like
25, 30%. Yeah.
So yeah, not good. And I think that was a big lesson that many of us will remember for our lifetimes. Maybe not, people that didn't live through it, but.
Well, thankfully, we were sheltered a little bit here in the Midwest, but I mean,
Very
it
much
was horrible for many, many, many people. And
Yeah.
that pendulum swung real fast the other way. And it's just started, even now, here it is, 15 years later, it's starting to kind of settle back in. I don't think we're ever going to see those programs where you basically fogged a mirror and they gave you, a loan. It's
Even a
just not,
small fog.
it's just not going to happen.
Nebraska was number 49 in foreclosures at the time of that. I mean, number one being the most foreclosures. So Nebraska was number 49. I was in California during those
Yeah,
years.
you were in the upper.
In the real estate. Yeah, I was in the oh shit, here it comes. That big fireball coming down the mountain place. Yeah. So yeah. So Nebraska never is always watches other people fall on their face first.
That doesn't mean that we didn't have some of it, but
We
we're
did.
just conservative by nature. I mean,
Yeah.
that's the way we are here to protect ourselves. So, okay, so gave you some more information as you go through this thing, tells you where the conforming loan limits are. If you start to dabble into VA, we can go over that. There isn't one. So theoretically, you can shoot to the moon on a VA if they have full eligibility. And it would really be to get into the weeds to tell you how that all works. But if you want to do something to learn more about VA, let me know, and I can get you down into them and dig you into all the bits that go into it. But that's why we have the list of the loan amounts on here so that you kind of know. Real basic stuff. What's a loan estimate? What's a closing disclosure? You're going to hear those terms constantly. And those are really important because they're obviously different. One's in the beginning and one's at the end. So those are things to kind of watch for. The estimate is just what it says. Closing statement is what it says. It's coming down to the end. Now, sometimes you'll have a preliminary closing statement that comes out, or disclosure, as it were. We send those out to make sure we're in compliance, knowing that we're adjusting and tweaking them as we go. But we always want to make sure we're on the right timeline so that we don't delay closing, because there's a lot of compliance driven dates that lenders have to comply with, as well as title companies. So you're going to have a partner that's your lender. You're going to have a partner that's your title person that you learn to like. You're going to have some of these people at your disposal to ask questions and be good resources. I put on here just real quick again, what's a bridge loan and what's a HELOC. They're very similar, but yet have a difference. So I put information on here that kind of tells you what those are and when they're used. We can always go over that some more if you start to run into different scenarios where those might be helpful. Right now, we do a lot of bridge loans so that our loans are not contingent on the sale of maybe a buyer's existing home. They don't all qualify to do that, but if they do, we try to help them do it simply because, again, we are trying to make sure that the seller is happy and doesn't have a lot of stress on them to make sure we get to closing.
So I have a really quick question. Sorry.
Yes.
So a bridge loan is not considered a contingency.
No.
Okay.
A bridge loan is a loan, and as long as I can qualify them with that payment, and they have enough equity in the existing loan home to warrant using a bridge loan, then we can do that for them.
If it's a bridge, so I have a client who is in the process of selling her house, but she will be an all cash buyer. So she's kind of been going back and forth on whether to wait till that house closes to actually have the cash, or she's been approved for a bridge loan as well. So that's what so in that situation, the bridge loan is still not considered a contingency, even if she's still under contract, but hasn't actually closed on the sale of her house.
That's a great question, and probably a better question for your mentor, because in my opinion, and I'm just going to give you mine, okay, which means really nothing, but if I'm a seller and you've offered me cash
Mhm.
and you've shown me proof of funds, then that's what you need to use. If you've offered me financing, which is what a bridge loan is, okay, you have to be approved for financing, then that's different than a cash sale.
Right. Well,
So-
and that's what I've told her. I've kind of tried to tell her, if you can come to the table with cash, I mean, that's the cleanest thing ever. So, and that's what we were talking about. And that's kind of where I was thinking would be, but you kind of answered my question. So,
Yeah, I mean, technically a bridge loan is financing.
mhm.
So you're getting a loan to pay for the house.
Right.
It's really not a lot different than a regular loan in the fact that you're still getting a loan. You're still being qualified for it. It's just that at the end of that, you're paying for it in full.
Right.
It's still financing though. Would you
Right.
agree with that, Carol?
Yes, I do.
Okay, I just want to make sure.
Yeah, and that is really something that, as much as I think I know about financing, I let that be like completely conversations between the buyer and the lender. I let them go with their recommendation based on the whole picture. Don't you? I mean, isn't that?
Yeah.
Yeah.
Okay, I know we're running out of time, so couple more things. I gave you timelines for when people mention words like foreclosure, deeds in lieu, bankruptcies, things like that. Every one of the programs has a different timeline that they require them to wait. VA is the shortest, then FHA, and then conventional. So these
Can you back
again,
up just a little bit, Alana, so that
Yeah.
they understand what you mean by the timeline. From the time somebody files a bankruptcy, this is what you're talking about, right?
yes, it's when it's a
Until
record.
they can get a loan
Mhm.
again.
Yep.
Okay. So
Yep, sorry.
most people think it just has to do with credit score.
Yeah, no, it's not about their credit score. It's about how long the industry is going to make them wait until they can have a new mortgage or another mortgage or get approved for a mortgage. So each one of those different of life events, bankruptcy is one timeline, foreclosures are another timeline, short sales are yet another timeline. So the timelines are waiting periods until they can apply for a new loan. It isn't when they file, it's when it's discharged or of record, which can have gaps of time. For example, the other day we had a gentleman that gave us his papers and we could see when it was filed, but the courts didn't file it as a discharge date until almost 30 days after. That's when it became a record with the courts. So the timeline isn't from the time he filed, it's the timeline of when it was discharged. And when we saw that, we had to make sure he knew he couldn't make his application until after that time. It's not something you can prep before. The guidelines require you to apply after the discharge date. So it's good to know those things because it sets folks up to understand what they are and not be disappointed when we go back and we say, sorry, you're misinformed. It wasn't from when you filed, it's after discharge and now you have to wait.
So a discharge date is the date that everything.
That's the go date.
That's the
Mhm.
go date.
Not the file date, because that's just when you filed it with the court and they may have taken
take
a month
months.
to get it
Yeah.
done.
Yeah,
Mhm.
okay.
So
just
these timelines, they don't change very often. In fact, they haven't changed for years. So these are not set in stone, okay, but they're good. They're really good to use for looking at them. I look at them all the time. Then I put one sheet in here, steps your buyer should know, things to get them pre-qualified, kind of keeps them on track. home inspections, things like that. Don't change employments, like my gal that quit her job the other day. Oh my God, that was
Gee,
horrible.
that's
We
the
went to
worst
verify-
call in the world.
Yeah, we went to verify her employment 10 days before closing, and they're like, oh no, she put her notice in and she's gone. And I'm like, excuse me, what? No, no. So that got really messy, and we had to do a lot of damage control very quickly, and it's just uncomfortable for everybody. She didn't think it was any big deal because the company was paying her through September and she was closing in July. So yeah. Anyway, reference guides, the very last page gives you kind of a quick rundown on Nick and I. Gives you websites to go to. USDA's is on here. And NIFA's is on here, first time home buyer. We can always do something on that. That's a whole nother level of information that, you know, we can go through if you find that you're kind of gravitating towards, you know, first time home buyers, which a lot of people are. So.
Were you able to do any of those this year?
Oh, Nick does them and we do them. Yeah, we did a few. You know, think of NIFA as an umbrella. It's on top of the programs. So the programs are still USDA, VA, conventional, and FHA. So those 4 programs are your platform. They're the 4 cornerstones, right? Okay. But on top of that is a partner that sits out there just here in Nebraska. NIFA stands for Nebraska Investment Finance Authority, and they are a partnership that can help sometimes with down payment assistance. They can help subsidize the interest rate slightly, but they have a whole nother level of criteria we have to make sure that we qualify for. But they'll partner with us on each one of those kinds of programs. So they're not a program. Think of them as a partner that's got money sitting in a pot over here that we want to take a little bit of it and we want to use it to help buy down a rate or maybe help them subsidize their down payment money.
That's
Okay.
the first time I have ever heard anybody say that, explain it that way, that they are a partner to
It's
the.
a partnership. It's
Yeah,
not,
it's
they don't
fantastic.
approve anything. They approve us
Mhm.
using their money, and they have criteria we have to meet for the buyers to do that, but they don't approve VA, FHA, they don't do that. They're just here to give us a little bit of money.
And they, it's all based on income.
It is, it's income based in conjunction with how many people are in the household, and it's household income. So if you've got an 18-year-old son or daughter that's working a part-time job, we got to count their money and they can put you over the income limit even though they're not on the loan. So it's household income, not just being a first timer, not just being on the loan. So we
Well,
have to.
let me ask you this question, because I don't know if you guys will think of this, but I think this is a relevant question for all the pandemic related income that has happened. Like now there's the Children's Act, where there's more given for certain incomes. And is that counted as income? Because
Nope.
that's not permanent
It's not permanent.
Yeah.
Correct.
So if somebody's getting, let's say they have 3 kids and they're getting $900 a month or whatever, that I don't, is it 300 a kid or something? I don't know what it is. So let's say they're getting that does not count as income for them. So they could still qualify based on what their regular normal wages and income are. Okay.
Because it's not permanent income. Now, on the flip side of that, you could say, well, anybody's job is not permanent.
Yeah.
Well,
Yeah.
that's really starting to, kind of cross hairs on that. They're looking for employment. They're looking for.
This is really confirmation on why you have to get a trusted lender involved early on in the process, because everything they will ask the hard questions. I personally don't get into people's credit score. I don't get into their income. any of that, because I really don't want people to feel shame with me if they have some credit issues, or some people just don't want to do that. And I tell people that say, well, it's hard to think about doing business with family, and and I say, I won't have anything to do with your business. All I'm going to do is facilitate. I'm going to facilitate you transitioning into a new home. The rest of that stuff goes, confidentially to somebody else. I really don't want to know that. So
yeah, there's most of the time you don't, and
Yeah.
sometimes you hear stories that are mind blowing.
Yeah.
So it's just as easy to
Mhm.
let them have one person to tell the story to.
Yeah, exactly. And keep
We work it
their
from there.
dignity in
Mhm.
their side of it, because even if people have had difficulties, it doesn't mean they can't get a home, and that
Right.
the lender can't work with them. It doesn't mean it has to be right now.
Yeah, sometimes these are our future customers.
Yeah.
Help to advise them on what they need to do. And in fact, we have a lot of people that seek us out just to have that happen. They come to us knowing that the timing may not be right, but they want to know, okay, what do we need to do to get there? And oftentimes, if they really mean that, we see them again and they become our future pipeline. Not everyone does it, but it's worth having the conversation, because you don't know who they know. They may turn around and tell another person and another person that we were kind enough to listen. We wanted to be good stewards of what they were doing and asking of us. And that just promotes you being someone that they trust and feel good with, and can refer you on to the next person, and the next person, and the next person.
Yeah.
So,
And that you're not the here today, gone tomorrow. We've got it. If you're
not
not,
transactional.
yeah, not
Relationship.
transactional, that you're in it for the long run, and you're willing, to wait with them while they do the work that they need to do to get their credit score or their, timing right.
Yeah.
So,
Yep,
yeah.
exactly. So was this helpful? Does it give you enough to just kind of get your head wrapped around a few things? You're not meant to know it all. That's what we do, but you can kind of sift through some of that information when people start to give it to you, and find a direction. Oh, this is complicated. We need to talk to somebody, and you can get them to do that. If it's cut and dry and you know what you need to know, you're moving on and you're doing your thing. So we're here to help do whatever you need us to do. And I'll make sure that I send to Carol the rest of the things that I sent to Tim on the different stuff that I put together here, so that you have it.
Yeah, you're not going
And
to get all this in 1 hour. So
oh yeah, there's so much.
her phone number is on all the materials.
Yeah.
You
And I did do a video the other day that kind of goes over the same stuff. So if you want to hear
I
my
sent
voice
it to them.
again,
They've got it in their email.
like nails on a chalkboard. But if you want to hear me talk through it again, I did it on that.
Yeah, that's super. Thanks, Alan. Do you guys have any last minute questions or any comments or?
Okay, great.
Thank
Well, if
you.
you need me, my contact information's on the very back. Same with Nick. And we try to be very, very good about responding to texts, emails, phone calls, whatever. So let us know if there's something you need. And I promise to get Carol those attachments for you to have later.
And watching your email, because they send a weekly update. Is it on Friday?
Yep. Nick sends that out every week.
Every week. So you kind of get a
Have
feel.
a great rest of the day and rest of the week.
Take care, you guys.
All
Thank
right,
you.
Bye-bye.
Bye.
Thanks, Eleanor.